Good evening, Ken at Tortoise Capital. This is the question and answer session for the Foundations course for May 8th, 2021. So thanks to the guys for giving me a really good set of questions to work with tonight. I'm going to start with Juan Carlos Angel's questions on the SSC. So the first question was, as I was analyzing SSC trades on a down red bar, I'm getting stopped out frequently. Every stop or bounce would produce a stopped trade. Every stop or bounce. And yes, I could turn around quickly and take consecutive collapsing dragon entries. Mechanically, I have identified excellent SSC trades, and at lower prices, the RR of the SSC improves, but is it realistic? Not sure what you mean without slides to show me what you mean. So I'm going to encourage you to put those slides and samples in the chat room so that we can talk about very specific things. But in general, what I will say is, and what I answered was, make sure that on the SSC that there's an unambiguous move prior to the entry. And then also be ruthless about getting your stop to no lose plus dinner for two so that your capital is not eroded. I should also add and say, and yes, when it's stopped, if you've got a collapsing dragon, as you typically will, especially early in the trade, take those trades. Now, is that realistic? Yeah, it's realistic. That's my primary trading technique on every time frame, and this has been the best year in the last 30. So the thing to remember is make sure that there is an unambiguous move prior to the entry. And that means that there was something like, just imagine a Bollinger Band mean that is flat and some kind of dragon that was floating around in there. And we had some kind of, narrow river. And then price broke out of there and made an unambiguous move down. Which creates, if we were looking at the MACD on a separate thing, we'd see the zero line, and we would have seen the MACD signal line make a breakdown and then start to reverse. The RL10 will have reversed. The dragon will have followed price and the RL10 out of the river. That river will have slowly been falling because that's what it takes to move the river, which is a great big slow thing. And remember, in that river, there are crocodiles. And the baby dragon will have been, which is a 3-period simple moving average, will have been trailing that RL10 all the way down through this move until this thing reverses. And that's going to be where the PSAR dot, when that thing finally flips, that PSAR dot is going to be here, and it's slowly going to start moving up when this thing works. Now, there's a lot of decisions that the price has to make as it is in that critical state. If that keeps going, that is going to turn to spring, and you're going to get an RLXD, and somewhere over in here, you're going to get an entry, and then that thing is going to just continue to go, or somewhere in here, it's going to make a decision, and it's going to start to fail. So one of those two things is going to happen, and either one of them pays you off. The collapsing dragon gives you the same expectation for a move to the downside like this. And whatever that size move was, cut, paste, it's going to be that size of a move as it goes to the downside. And then on the upside, whatever the that Bollinger Band mean in the middle of the river is kind of the demarcation point about what kind of move is this going to be to the upside. And so this is going to be leg one, a return to the Bollinger Band mean. That is the least surprising move of all, is that an exaggerated move away from the mean reverts to the mean. That's the least surprising move. But if it holds on and makes another move, this is leg one and that's leg two, this SSC is going to pay off big time. And remember that your little risk box is just like that, down to where the PSAR flipped and to where the RL10 reversed. This risk is the demarcation to to the unambiguous next leg down. So what would you expect from a setup that looks like this? What you would expect is small, manageable risk. You would expect frequent failures. And you love frequent failures. You love for this to fail because it's going to be your gateway to the trade you really want, which is the collapsing dragon. So the only job you have is to determine how fast can you get your stop to no lose plus dinner for two in here. Is to take your stop and get this locked in so that from your entry, you can capture something, and then your seed capital is protected, and then it's a science project to see how far it will go. It's not unusual to see a win rate of 0.5 to 0.6 on this, meaning that I got at least a no lose plus dinner for two, and sometimes I get to the far side of to the Bollinger Band mean, and sometimes I get to the far side of the river, and sometimes I get to the floodplain, and sometimes I get to Z3, and sometimes this thing fails right away. So you're going to see average wins of 0.5 or 0.6 position sizing R, which means that the average move, remember, if this is a 0.2, the average win only gets back to the Bollinger Band mean on average. A lot of times it won't even get that far, but sometimes it gets to the far side of the river and the floodplain and Z3. And the frequency of that, the further and further it goes, the less frequent that occurs, but it averages out to a 0.5, 0.6 win with a greater than 50% win rate and the average loss being 0.2. That's a 3-to-1 reward to risk ratio. And yet, many times it fails. And the failures are small and the wins are large. And sometimes the wins allow for multiple entries. Zoran asks me, what do I mean by crocodiles in the river? What I mean by crocodiles in the river is that this river, our metaphor for the river, where is the place that you get chewed up? You get chewed up if you're trading around very close to the Bollinger Band mean. That's what I mean by crocodiles. Watch a herd of animals in Africa trying to cross a river at a choke point. You know, if the river looked like this, and there's some little narrows in here, and then it expands, where does the herd cross? The herd crosses here because of the width of the river is narrow. Where do the crocodiles wait for them? The crocodiles wait for them here, and they live in the middle of the river. So what we have to have on this trading strategy is the importance of the unambiguous move to the downside so that I have room to get my positions in, so that if I get to the middle of the river and it starts to fail, I exit quickly so I don't get chewed up. But that means that I cannot take, like when the river is sideways in this segment right here, and that Bollinger, the dragon is going to be horizontal in the middle of the river, you can't be taking the RLXDs. You can't be starting those trades every time it crosses the dragon in the middle of the river, because you're in the noise zone. You're in the noise zone. You have to wait for that price to break out of the river and then start to reverse, so that you can have a small risk box, so that you can have multiple execution risks just to get back to the Bollinger Band mean in the river. If you are spending all your time trading around in the middle of the river, that's where the crocodiles are going to eat you, one bite at a time. Yeah. So when we think about this move in a larger context, now I'm going to connect this to some other patterns. So anyway, that's how I would answer Juan Carlos. But the next step on this is that when that price breaks down and you get that nice return, and then it makes a peak and it starts going like this, each next segment, so like there might be a nice move in here where you entered in a supported spring crossing and then you got out at the sniper, and you were able to make this trade here for the win with a very small risk box, and you were able to capture 1, 2, 3, maybe even 4 legs up. Hey, the next segment down can be smaller, and then the one after that gets smaller and smaller and smaller. And what you'll notice is that the Z3 lines expand during the volatility, and then they start to compress until ultimately this comes up and creates an opportunity box in here, the Z3P trade, where the Z3 lines have pinched to a very narrow range between Z3 and Z3. So there are really three time segments in here. There's a time of expanded volatility, contracting volatility, and then abnormally compressed volatility. So in this period of expanding volatility, that first move down starts creating the momentum. And then the big oscillations is what creates this large spread from Z3 to Z3. That's where you're getting these large directional moves compared to small manageable risk boxes that give you the ability to win. But at some point, there's a tipping point, and maybe the next segment is big enough to trade, but it's not as big. When you get out here into the second time frame, this is what we call sideways quiet channel, where the volatility is diminishing and the amplitude of these waves is diminishing, and there's not as much room. And what you'll notice is that price is spending more and more time inside the river, which is where the crocodiles are going to eat you up. So when you have the unambiguous move, this harsh winter that creates the opportunity for the SSC, you're trading in a period of expanding volatility. After a couple trades where this thing is starting to oscillate, the SQC is a time to not trade until you get into Z3P terrain, in which this tight compression now allows you to frame some risk boxes in here that allow you to take the breakout to the upside or the breakout to the downside. So we have this little sequence where you have an SQC, sideways quiet channel, is happening, and then that will lead to a Z3 pinch, which is tradable, and then that will lead maybe to a super pinch, which is the most desirable quiet time frame, right? So the sideways quiet channel is not a time to trade. Z3P is a time to trade, and the super pinch is an even better time to trade. So sideways quiet channel, no. Z3 pinch, yes. Super pinch, double yes. How do you know when you have a Z3P? The Z3 lines have been compressing, and intraday the width of the Z3 to Z3 is less than one frog box. And here's that Bollinger Band mean right in the middle. And you'd actually see the edge of the river in here, like this, and the floodplain, like this. That's very, very good. Because of mathematics, you know, that dragon, which would have been, that dragon's going to be in there somewhere. You know, he's going to be on one side of the river or not. And then you're going to see the RL10. You're going to see the RL10, which is the price, which will have been oscillating, comes in, and that's in the middle. And you'll see the you will see the RL30, which follows the RL10, but that's going to be all clustered inside. So this is a mess inside here. But the Z3P says, hey, that has compressed so much that a breakout from the Z3 could really go in either direction. And I'm going to use, maybe half of that. I'm going to use the Bollinger Band mean to the edge of the Z3 as my risk box. And then this thing quickly starts expanding. And then my job is to get my stop to no lose plus dinner for 2, and then start picking up whichever form of the trailing stop I want in order to lock in these different moves. And that's the same whether it's to the upside or the downside. Well, that's what the Z3P does, is that I've got the Z3 to Z3 is less than 1 frog box, and price is approximately horizontal for the last 10 bars. Mathematically, that's the only way that you can see that happen. Well, if that's the Z3P, how do I get this double plus goodness of the super pinch, I wonder? Well, what you have in the Z3P is, instead of this Z3 pinch breakout occurring, what happens is this continues to get more and more sideways. And now you have this very tight frog box, right, with the Z3P lines in there. And it's less than 1 frog box wide, right? And now all 4, what you're going to get different now is all 4 regression lines are within the frog box too. So that means the RL10 is in here. The RL30 is inside there. The RL90 has joined. And maybe the RL270 was up in here. All 4 of those regression lines are now tightly bundled, and they're inside of this channel too. Well, what does that mean, a super pinch? It means 2 things. The first one is that volatility has tightly compressed, abnormally compressed volatility. And the second thing is that fair value agreement by all participants. So the RL10, the RL30, the 90, and the 270 represent fair value through the lens of 4 different time frames. The RL10 represents the price on this time frame. The RL30 represents the health of the market. The 90 represents the health of the next higher time frame. And the RL270 is the long-term fair value for this time frame. But when all 4 of those different perspectives all agree that this price right here in the middle is correct, and the volatility has compressed, this is like an acorn. This is like a nice tightly compressed acorn, right? That's going to grow into a great big beautiful oak tree. That compression of that super pinch now creates quite often amazing multiple leg moves in either direction. It's a special case. The super pinch is a special case of the Z3P in that it added all 4 of the regression lines are now also inside of that mess. And the Z3P is a special case of sideways quiet channel in which the volatility has compressed to an abnormally tight degree, and that's good enough to trade. But sometimes it compresses even further and creates a super pinch, which gets my attention every time on every time frame, because this will often result in legs with multiple moves, which is perfect for kata 2 and buying on dips. So when you have a super pinch, it's not unusual to see the first breakout, pause, second leg, pause, third leg, and pause, and you get these multiple leg moves as we had range compression and price agreement all funnel into this nice tiny little super pinch, and then the expansion from that is really worth noticing and trading. Okay, so that's what I want to say about that. So Juan Carlos, is that realistic? It absolutely is. Right. So he says then in a follow-up, is there a point where you should take a position of targeting a down day only? You go in the intraday, you go in the direction of price. At what point should you stop looking for a rebound and concentrate on the directional move down? If you're following the method and the instruction, the only time that I'm trading is when I have a critical state. I must have a critical state, which means that in this little trade frame, inside this trade frame, where we have a breakout possibility and a breakdown possibility, and that makes this the yellow zone inside here, the price of indecision. I'm always ready to trade that in either direction. So I have no way of knowing ahead of time that this is going to be a down day and it's going to keep being a down day. I can only trade with the price and then get my risk out and then see how far it goes. Now, are there times when I think it's more likely that it could be a down day or an up day? Yeah. Like if we've had strong moves in that direction, I think there's a probability of momentum continuing. So if that was swing trades, that would be a 5-day down failure. You know, the 5-day down trade frames this trade like this. It says I'm going to go long here or short here. So I'm ready to go in either direction. Once this thing starts failing, though, like if I'm looking at this on a daily chart and it fails below yesterday's low, yeah, on the intraday trade, I really want to emphasize this move because fear is stronger than greed. How far can it fail? It could fail a range stat move. So now I've marked out the dimensions of the maximum reasonable intraday move that it can make. And so while it's failing, I want to emphasize that part of the trade. But remember, the supported sprint, you can't ever just say, oh, well, that's all it's going to be. You might make a decision to only go in that direction. Like if this was a bear market and you had a 5-day down and it started failing, you might say, you know what, I'm only going to take the downside. But by the same token, right now I'm trading ETHE and only to the upside. Why? Because it's going up, the strongest crypto, and you can't short that symbol because of the note. It's not shortable. So I only play the upside. So all I do is, while it's moving up and I have my core position in, the swing trade is working. On the intraday trade, I wait to see, hey, let me see that thing sell off to a dip, and then let me try to trade this with a tight risk box on an SSC. And the only thing I can do is trade that to the upside, because I can't trade the collapsing dragon because I can't short it. So there are some situations in there, but what I am searching for is the essence of this trading style, is the critical state that allows for a larger than average move in either direction in a shorter period of time than normal. Because that's where you get the strong moves. When you have that tight minimum manageable risk box and it's compressed, the big moves occur in either direction with the equal enough probability that you got no way of saying ahead of time, well, which way is the likely? They're both, it's a coin flip. But you start getting enough of those down moves, you might say, hey, I'm going to keep looking for those. And for me, I would just say, like on it, if it once supported spring crossing and then failed into a collapsing dragon and I made bank, and then it tried to support a spring crossing and I got to no lose plus dinner for two, then it failed, then I made bank. Yeah, I'm always ready to be short that one. But the farther this thing goes down the stack, the greater the probability of a recovery move. So there's never a time that I am not framing it in both directions. To say it affirmatively, I'm always trading it and framing it in both directions. A violation of the fail stat indicates it may be a runaway move to the downside all the way out to the range stat value. So this is an intraday technique. So right from the opening, so here was the close, and let's say that here was the open. That makes this the distance from the close to the open. That's the gap. For the intraday trader and the frog trader, doesn't matter, because what we've done is on the frog trade, all we do is we make a hybrid frog box around this thing and call that a critical state. And we say, look, this thing could move up to a range stat. That's the maximum reasonable intraday move from the open. The open, remember, is simultaneously the high and the low of the day. Mathematically, it has to be. So it could be the low of the day, all we know. And if it moves a range stat move to the upside, that's not allowed to be surprising. The range stat is the max reasonable intraday move. The maximum reasonable intraday move. Guess what? It's also the maximum reasonable intraday move to the downside. So that move, a plus range stat and a minus range stat minus, establishes the reasonable price area for normal moves. So now, what does a fail stat mean? Well, what we've done is that we've taken statistics and we've gone from the opening and we have found the low of the day, whatever the low of the day was, for the past 200 days. And we've computed the distance that it fell from the open down to the low of the day, and then it reversed, and then went up the rest of the, whatever. It did whatever it was going to do. So we're interested in what is the percentage that thing has routinely and reliably, on average, fallen to the low of the day. So we call that the fail stat. So if tomorrow we've computed that fail stat and it opened here and it fell that percentage and then starts to reverse, guess what I'm going to do with that information? I'm going to have my little minimum manageable risk box on here. I'll probably have a supported spring crossing, and then I'm going to take that as my entry, and I'm going to take that as my risk, and I want to trade it in that direction, thinking that maybe it could go I could find the low of the day and add a range stat to the upside. And maybe that's how, and so with my tiny little risk box, with that tiny little risk box that I've drawn here, I'm risking that much, and I'm hoping that if it goes in my favor, I'm going to capture that much. And what I'm going to do is I'm going to keep managing my stops in the usual way to see how much of that I can lock in until it decides to exit. So I'm trying to capture those moves on the way up towards a range stat. Well, back to this original idea, what if this thing goes to the fail stat, but instead of reversing and going up, it just continues to fail? Oh, that's the kind of a day in which this thing might make a range stat move to the downside. So if it falls through a fail stat, man, that's a decision time that I want to be short, because this thing is failing more than the normal ritual amount. This is the kind of a day that could be a range stat to the downside. And because fear makes those moves happen faster, I love a failure through the fail stat as a signal to really concentrate on the downside move. And I will project it to go all the way out to the range stat and try to start locking in these pieces of the moves to the downside. Next. Also, the best entries for an SSC is when it went so low that it gives a final huge rebound. Could this be identified with how many standard deviations past the range static? Yes, 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 and yes. So the range stat is usually 3 or 4 frog boxes, each of which is a standard deviation. And if it moves all the way to the range stat and then goes beyond, holy mackerel, that rebound is going to be extraordinary. But meantime, with collapsing dragons, you should have been capturing some of those moves, and then the SSC rebound should be amazing. That's why we pay attention to the Z3 lines and the frog boxes and so forth. Okay, moving on. Paul asks, I'm still wrestling with the MACD line. I understand the seasons and the concepts. I'm coding it in TradingView and Excel, but tying myself in knots and getting the same seasons as you are. I've calculated EMAs, 10th, and plotted the MACD. So I suspect I'm doing something wrong. So I'll say, let me reinforce again that the MACD is a 10, 30, and 5. The 10 and the 30 are simple moving averages, SMA 10 and SMA 30 of price, which means that the SMA 10 is mapping to the dragon's spine. So, because remember, the dragon is a Bollinger Band mean 10 plus or minus 0.5. And that's a simple moving average. So when you have the dragon, his center line, the middle of the dragon's spine, is a simple 10-period moving average. That's the SMA 10. And then the move out to the skin of the dragon is plus or minus 0.5 standard deviations, right? So it gives you some kind of like a noise range. The SMA 30 is the same as the river. What's the river? A Bollinger Band mean 30 plus or minus 1. So when I have the river out here, and I have that simple moving average in the middle, the Bollinger Band mean, the average of the Bollinger Band mean, is a simple moving average 30. Plus or minus 1 standard deviation, plus 1 and minus 1 of that 30-period look back. So when I do a MACD histogram, 10, 30, and 5, what I'm really comparing is the relationship of price between the dragon and the river. So when I have a river and price is going to fall out of it, that's going to pull the dragon with it, because that's a 10-period look back, and the river is a 30-period look back, and that's going to be slower to recover, and therefore this ratio and relationship between the 10 and the 30, as we get directional price, that gets wider and wider. Well, on the MACD histogram, when we're looking at a 10, 30, and 5, when we see price failing and the RL and the SMA 10 is lower than the SMA 30 and it's failing faster, you're going to see that expressed as the SMA 10 is less than the 30 and pulling away from it. And if you've got a histogram going, it's going to look like that. And the signal line is going to look like that. And we color code that red until the dragon and the price starts to recover. And now it starts getting closer and closer, which means that this thing is going to roll over into the spring until such time as the dragon is now higher than the Bollinger Band mean of the river. And now you're going to have rising prices and the dragon going to the far side. And that's going to be the summer in MACD until it starts to fail. And then that becomes the fall. So the MACD histogram and the MACD 4 seasons is a simplification of the relationship between the dragon and the middle of the river. And what we want is the maximum excursion to the downside. We want the farthest fail to represent the most extreme divergence between those two, so that when it starts to correct back to the Bollinger Band mean, we have the largest opportunity to capture a large reversal. So the SMA 10 and the SMA 30 of the MACD are really just representations of the dragon and the river. The smoothing constant of 5 is an exponential moving 5. And what that does is it produces a smooth 5-period moving average of the signal line. And when that crosses, you have confirming evidence that the spring is really happening. And so we want that to be sooner rather than later, and that's why it's an exponential 5. Simple 10 and 30, exponential 5. That's how it's formed. Next question. On page 8 of the daily report, there are seasons in the table. So let me reinforce what that is. I should have pasted one of those in. So you can. So on page 8 of the daily, yep, here we are. Yeah, he's talking about the my answer to him was that the data sets on the left-hand side for the ETFs and for the Dow 30 are based off of daily. Those are the daily seasons, but he's really talking about this set in here. So there are 8 little categories, and naturally that's not going to show very well. Let's see if we can zoom in on that a little bit. Yeah, so those 8 categories are monthly spring and monthly summer. And when the dot is in there, that means one of those 2 conditions has occurred. Now, I'm not tracking for my long side swings. I'm not interested in monthly fall and monthly winter because the longer term trend is not supporting a good growing season. But what does form a good base for growing seasons is a monthly spring and a monthly summer. By the same token, I'm really specializing in weekly springs and weekly summer. And then I look at daily winter, daily spring, daily summer, and daily fall. So for instance, Squarespace, I really like because it's in a monthly summer, long-term, very good, and a daily fall, right? So when I start combining those things conceptually, I know that I get my best results in those combinations where I have, in the life cycle of trading on the monthly chart, I might have had a period of monthly winter and then monthly spring and monthly summer. Those are easy. I mean, and everything is firing there. That's so obvious. Like blended monthly rebalancing is finding those things because they're really pulling away. But where I like to get started are these 2 right here. I don't like monthly winter. Right. Let's see. pull that chart back up again. Yeah, so I'm actually monthly spring and monthly summer, I should say. Sorry about that, I misspoke. I want to see things that on a monthly basis are already strongly moving up. And then I also know that things that were strongly moving up and fell into the fall could have like a Kata 2 re-entry. And so what I'm hoping to see is, even though it's in the fall, I'm hoping to see the next leg and that people are going to buy on dips. So these are the two monthlies that I really love for swing trading, because I want to own those and just let them continue to grow. Now, I love these two for short-term violent downside trading, but I'm not doing that with swing trades. I already know which ones are failing, and I'll use these for short targets, but not for long swing patterns. By the same token, I also know that I could have monthly fall, or I'm sorry, monthly winter, and inside of that, I could have weekly winter, weekly spring, weekly summer, and weekly fall. Yeah, dear. So I like weekly summer. I like weekly spring and weekly summer. I like catching it a little bit earlier in the trade, right? So I'm actually looking for spring and summer. But because I'm not looking at the monthly there, what I really am doing is, and I'm not looking for monthly winter or fall. I'm actually coming out into this one and saying, oops, sorry. What I'm looking at on the weeklies there is, I love the weekly spring and I love the weekly summer, because these things are early in their phase. So if I had a monthly summer and a weekly spring or a weekly summer, I love that trade, because now I've got two different time frames really working in my favor. By the same token, for swing trades, I like monthly fall, weekly spring, and weekly summer. And then inside each one of those, if I broke that apart even further, I would have the each one of those is thin sliced with the dailies. And so I look at all four daily bars of, I just want to know, is it winter, spring, summer, or fall on the daily? But what I'm really trying to concentrate on are these two windows. I want to see monthly summer plus weekly spring or summer, or monthly fall and weekly spring or summer. Those categories there are the ones that have produced for me the best starting points for long-term swing trades that continue to drive. Why? Because they're being supported by monthly buying pressure, and it's already above the zero line, so it's easy to believe in. And then the weeklies are in favorable seasonal conditions for growing. So I'm stacking up edges in my favor with respect to seasonality. He asked, is the MACD line, I've already answered that one, so, but again, simple moving average is 10 and 30, and the smoothing is an EMA 5. If so, what part does the signal line play in your analysis? So on the MACD histogram, there's a 0 line, and the MACD signal line, as it's going down, so we can see that that's in winter right now. Why? Because it's below the 0 line and the slope is downward. So where the signal line is being drawn tells you which season that you're in. So that signal line tells me the season. I guess I would just say it that way. So how should we interpret the MACD z-scores? Well, it looks like this. There are times when the winter comes down this far, and sometimes the winter only goes that far, and sometimes the summer only goes that far, but sometimes it goes that far. So at some moment, and I'm going to use the winter. Let's suppose that on the current reading of the winter, it's gone here. Then what I do is I put a Bollinger Band 30 and 1 on the signal line. On the signal line itself. So it goes back 30 time frames, and then it creates a Bollinger Band with plus or minus 1. And we call that the red river. So I'm going to draw, and so it may be that it looks like this. Imagine that should be red. So I just show that as a red river. That shows you the range of normal of the MACD line over the last 30 periods. And when I see the signal line is out of the red river, then that means this move to the downside was an abnormal stretch away from the normal of the last 30 periods. So what's the z-score? God, that was horrible. The z-score of the MACD. That simply tells you where price is with respect to the Red River. I'm going to draw that again in a much cleaner way. Because this is the z-score lesson, right? It doesn't matter whether it's MACD or the up in price. So when we take a slice of price or the MACD, and we have the max and the min, and we've computed the standard deviation, then the middle, whether it's the river or price or the MACD, the average has a z-score of 0, because the way you compute the z-score is the value minus the average divided by standard deviation. So what that does is it tells you how many standard deviations away from average the value is. So if the MACD line came down to here and we took that standard deviation, we would say, all right, here's +1 and -1 standard deviation. And we go down to here and we say, oh, that thing is 1, 2, 3 standard deviations below average. That gives it a z-score of -3. If this was price, It would be the same thing, only here we'd have, this would be the river. The river is plus or minus 1 standard deviation away from average, and the floodplain is plus or minus 2. So if it's price and the river, then that's how that works. If it's the MACD and the Red River, then the MACD Z-score tells you how far the signal line has fallen below the Red River. So when I have the MACD 0 line here, and the MACD is in the winter and has started to hook, I say, well, how far did it get out of the Red River? So if the Red River is here, and the average, the middle of that Red River was there, that's going to have a Z-score of 0. The skin of the Red River is going to be +1 and -1, and then I can just count how far down the stack the Z-score got to. That tells me how extreme was that move, how abnormal. And I want, all other things being considered, I want the strongest, sharpest move away from normal, because when I go up and look at price, this will look like a massive price collapse that has now started to recover, heading back to the middle of the river. So the MACD Z-score, MACD Z-score, allows us to rapidly estimate which of the symbols have made the most extreme move with respect to the river. So when I look at this, chart, what I'm looking for is, I love EWW. Actually, let me find one in the winter. I like Moonshots best because that has fallen the most. But at -0.18, it's still in the Red River. That's not extreme. But DIA in the summer made an extreme move to the downside. It's out of the Red River. That means its pullback was below the river, but it's still in the summer, so it's climbing. That's actually perfect. It's in the summer, so it's climbing, but it's out of the Red River. It means it has much more room to climb just to get back to average. That's why I color code the MACD Z-score. Like things in the spring, like EWJ at -1.28, what does that mean conceptually? Just by looking at that, I can tell you. Select our menu, new. EWZ has a Z-score. It has a MACD season of spring and a Z-score of -1.28. That means that when I look at it, stand by. That means when I look at the Z-score and the chart, the 0 line is going to be here. It will have fallen into winter and has started to move back into the spring. And then the Red River is up here looking like this. And that means that at a Z-score, this should be closer. At a Z-score of -1.28, that means it is out of the river by 0.28 standard deviations, because this is the 0 line, and that's -1, and that makes this -1.28. So that's what I want. I think it still has room to run back to the normal, and then if it gets beyond, this thing is going to become, when it gets above the 0 line, that's going to become a long growing summer. So I love this. The slope is rising. It's still out of the normal, meaning that there's momentum for it to go, and then it's going to be close to breaking into the summer. So that's how I use that table to quickly find the patterns that I really like. I'll explain that one to death. What I'm looking for is the first flag of a change in the season that might point to an SSC or a CATA 2. So if that's what you want the harshest winter, meaning that the Z-score went to the lowest outside of the Red River. You want to maximize the severeness of the winter, and you want to see that it has just started to roll into the spring. This is where you find SSCs and you find owls when you're looking at the MACD table. When you see this, it started to make the turn well outside of the Red River. This is where you're going to find the best setups on the price chart for SSCs and owls. And when this fails, you're going to get collapsing dragons. This is what I look for all the time. All the time. Yeah. The more extreme the Z-score reading when the seasons change, the more powerful the signal for a reversal of trend. Olaf asks me, would love to hear my thoughts on the minimum manageable risk box. To me, the MMR represents a decision threshold where even if I factor in the noise of the transaction costs and all that stuff, the price is still making a signal move. That's correct. So when I am setting up the minimum manageable risk box, conceptually, what that means is, I'll draw this a black line. MMRB. What I'm saying is that I'm trying to make that as small as I can, so that when I enter and I set up my exit trigger down here, any signal that when price crosses that line, there is no doubt in my mind that the upside opportunity, the hypothesis of the upside trade, is over. It failed to do what I hoped it would do if it was going to win, and it's going to the downside. So what I have to include inside here are all those elements of friction that Olaf is talking about, because I want that to be -1 execution risk. So it might be, so what, if the dragon was here like this, and that might be my trigger to exit. But the minimum manageable risk box might have been where the RL10 reversed and then crossed the dragon. And so I can set up my minimum manageable risk box to here, because when I execute where the dragon belly was, I have to account for slippage and spillage and delay and transaction costs and all that stuff. I want this whole thing to be my one execution R. And then that's only going to be 0.2 position sizing risk. So this minimum manageable risk box is where do I have to put my 1R stop so that when I make the decision to exit, I still am not taking more than a 1R execution loss. So my job is to try to compress that as much as possible. In actual practice, on the intraday trading, because slippage is so prevalent, I actually have to use the bottom of the RL10, which is where the PSAR hits, and I might have to execute and pull the trigger to exit here at the bottom of the dragon, and then slippage and spillage hits there. But on swing trades, when I want to execute here, I can execute right there. The spillage and slippage doesn't matter that much. So the minimum manageable risk box on swing trading for me is usually this one, where the execution and the bottom of the dragon is the same thing. But in day trading, I usually have to use the belly of the RL10, but I have to execute on the belly of the dragon, but count the minimum manageable risk box as the bottom of the RL10. Okay. On the swing trading, 2 ATR is a reasonable place to start on the execution risk, because a move of 2 ATR is usually enough to just say, hey, that thing ain't moving, but you can season that. Finally, Zoran asks, I'm going back and rewatching the Foundations videos, and in one of the videos, I mentioned that we want to find the movers, and so we want to look at the fastest, I would say fastest moving sectors, the most volatile sector, and then the movers within that. And then I'm wondering, he says, when we find movers, what kind of entry could we use to jump on the trend? Like I have been watching ETH steadily go up this week while waiting for Apple to pop. Similarly, lumber, cut, and wood. Or how can we take advantage of that? Well, Zoran, that's what the Saturday night podcasts for swing trading and the Sunday night podcasts for day trading frames are looking at. We are looking at very specific patterns and trade frames about where to get in, how much risk to take, where to add the second entry, when to cut it loose, for where's my initial risk and all that stuff. Where do I stop and reverse? So that's what the trade framing questions lead you to do, is to frame the trade so that you can very specifically get in. But all of these things that I'm talking about now, that I have been talking about, all of these are patterns that work. The SSC, the SFC, the OWL, the COTA 2, and then the mechanical entries for swing trading like 5DD, washout patterns. All of these are very specific frames that give you precise entries for risk and reward. And the thing to do is, when you're looking at a target, excuse me, what you end up getting is on something like ETHE, which has been doing this. What you'll realize is that every one of these little pullbacks is like a COTA 2, because the thing is just working, and COTA 2 is a way to buy on dips. If this had been some kind of amazing sell-off and then was starting to reverse, well, we'd probably start that with an SSC to the long side. But if it failed, it would be a collapsing dragon. But if that SSC started to work, at some point that upward momentum makes all of these little COTA 2 entries suddenly very attractive. So what I really hope to do is get started well with an SSC or an OWL, and then slowly convert that into a series of COTA 2s. And if you take a look in the chat room at Luke's management intraday with the 3 scoops on the Russell, that shows exactly how to do that. I tell you, the other thing that I've talked about tonight too was that little acorn trade of the super pinch. Man, if you ever see a super pinch, that's how you get into it, when it super pinches and it starts to work, and then you get that breakout, and then COTA 2s all the way up the stack. That's what you want. And it also works in a Z3 pinch, where you get the breakout or the breakdown, and then you get COTA 2 entries in either direction, and you start riding those longer and longer waves. So that's how you do it. You become proficient with these different patterns, and then you start using those as templates to frame your trades, and start with the SSC, then the SFC and COTA 2, and then the collapsing dragon, and then the Z3 pinch, and then the super pinch. And now you have a whole ecosystem of chart templates and trade patterns that allow you to get in. And then what you can find is, if you are hooked into a nice swing trade with COTA 2s, when you look at the turbo trades inside the day, you might see, there's an SSC as part of a larger time frames kata 2. Watch all of the strategy videos of this past week, and you will see me doing that with ETHE as I am turbo trading the girls' swing trade patterns in Ethereum, which we are crushing, he said, knocking on wood. All right. That's everything I want to talk about. We'll get this published and posted. Hopefully you find it. Oh, wait a minute. There's some questions that were just added. The Red River is a Bollinger Band mean 30 built, no, on the MACD line itself, not on the EMA 5. So just to clarify for Danny, in TradeStation, when I, or not TradeStation, I'm sorry, in TC 2000, when we set that up, and we put the MACD 10, 30, and 5, what you get is a MACD signal line, which is this 1030, and then you get the little 5-period moving average is, and you get the crossover. You're getting confirmation that thing is actually reversed. Now in your charting pattern, if your charting pattern is treating the signal line as the smoothed version, then yes, EMA 5 is the smoothing constant on that calculated relationship of the 10 and 30. So it's kind of, you just use the standard patterns on there. Yeah, it's not on the price, because remember, we on our big charts, we have all that price action up in here, and we're using, the river and the dragon and all that crap. And then MACD is being based off, the Red River and the smoothing constant is being done off of the MACD line. Okay, so yes, you are correct on that. All right, that's everything we got. We'll get this published and posted in the usual